All right, good Thursday afternoon, and welcome back to the Finom Group's State of the Market. I am your host, Seth Golden, and we're in the midst of what could wind up being a 6-day rally in the S&P 500, and I believe this would be a 9-day rally, which seems almost certain in the NASDAQ. NASDAQ up 9 days in a row, and we're hitting record highs on both the S&P 500 again. This is a 63rd new high of the year, only to be so far eclipsed by 1995, where we had 77 new all-time highs in that calendar year. A bit choppier here today. We've got some overheated and overextended conditions in the market. We'll get to that in a little bit. You can see NASDAQ futures at least. We've got the bond market yields are under pressure. We got strong bid in bonds pushing bond prices higher and yields lower on the day. Up 0.9% here on the NASDAQ, leading the way. Small caps under pressure. The Dow 30 under pressure there. S&P middle of the road, just continuing with its rally, but off of its high. New all-time high for the S&P 500, 4683, set earlier this morning, folks. If you've been of the opinion the market's due for this, it's due for that, it's clocking in, it's clocking out, it has an expiration date, this market is disappointing you. Do not engage the market with those kind of preconceived notions. Market is not on a schedule. But there are seasonal factors that we like to appreciate as investors. And usually those seasonal factors this time of year tend to be positive. So with that, again, welcome to this week's State of the Market for our Finom Group members. Please keep in mind that I will be in travels this weekend to North Carolina. So we will not have a weekly research report this Sunday. It's the first time we haven't had two in a row. Do forgive, but we will have our normal weekly research report in the following week. This week's State of the Market is going to be a little bit long to kind of compensate, and we probably need to dive right into things. With just 2 months remaining in the 2021 trading year, investors are gearing up for the typical seasonal tailwinds, but also recognize that markets are trading at all-time highs, heading into a tapering storm, right? We got the Fed's words just yesterday during the FOMC press conference with Chairman Jerome Powell that indeed they are going to deliver on the expected $15 billion worth of tapering on a monthly basis, which will probably take all of quantitative easing out of commission come June of next year. Anything can happen between now and June of next year, of course. So that schedule, if you will, is tentative. But anyways, the tapering storm, that's a question I'll leave open-ended for investors and traders alike, as each will be approaching the end of the year with preconceived notions, biases, and objectives. In this week's State of the Market, I'm simply going to outline my thoughts as the Chief Equity Strategist of Finom Group and by way of what I believe to be important facts and stats. We'll take a look at some present market conditions, analysis, and general thoughts for investors and traders to refer to through year end. In other words, keep this State of Market kind of bookmarked, if you will. While I could commence this latest narrative with a number of notes and thoughts about the upcoming Fed meeting, which happened yesterday. You can see I've been constructing this since yesterday, whereby the central bank will likely outline plans for tapering, and they did. No, nothing is more important than earnings. The Fed meeting, as proven historically, will not prove to sway earnings in either direction. And so that leaves us with Q3 2022 earnings. And this is where we are as of the end of last week. FactSet will update their tracking model. It's usually updated every Friday or Saturday. Just depends on their schedule. But we came into this week with the S&P 500 tracking 36.6% year-over-year earnings growth. How important is that? Well, we came into the quarter, right, into the kickoff of earnings season with basically 27.5 projected earnings growth for the Q3 period. So we're already, let's call it 9 percentage points above the expectation. And more than likely, this 36.6 will rise once again come the updated tracking model from FactSet over the weekend. I would be looking for 38.5, if not 39% year over year Q3 earnings growth when it's updated. We still have 2 more weeks to go in the earnings season. There will be, bits and pieces of S&P 500 companies that are going to be earning after that, but the culmination of earnings season will be 2 weeks from now with retailers. They start their earnings rollouts next week. I believe we have Walmart, and then you get into all of your Kohl's, your Dillard's, your Skechers, Foot Lockers, your Macy's, so on and so forth, TJ Maxx, Ross stores, et cetera, et cetera. Point being with earnings is that they are coming in better than expected. And they're coming in better than expected with better than expected margin growth. More than 58% of S&P 500 companies that have reported to date are reporting an increase in gross margins. That is a very important fact. The market was worried. Investors were worried. They were concerned that all the issues surrounding supply lines, labor shortage, rising wages, port congestion, all of these were contributing to higher CPI, higher PPI, consumer price index, producer price index, and how much of that would weigh on Q3 earnings. Well, it turns out that by and large, most companies have been able to absorb some of those higher cost inputs, if not pass along some of those pricing pressures to the consumer. And that is why we are seeing better than expected earnings results. Dr. Ed Yardeni, he's one of my favorites, formerly of Deutsche Bank. Now he runs Yardeni Research. He was quoted in a Bloomberg article just yesterday. New York-based market strategist Ed Yardeni said this year's surge in U.S. equities is distinct from 2020. And that's a positive sign for investors looking out the next 2 years. What does he mean? This year's so-called melt-up has been led by a melt-up in earnings rather than in valuation. Remember, last year the market melted up in price, not necessarily earnings. So the price in the PE multiple was going higher while we were trusting that the earnings would come back. And that's why we came into 2022 with a 23 times forward-looking earnings for the S&P 500, 23x, if you will. But since the beginning of the year, the forward PE multiple for the S&P 500 has dropped all the way down to, at one point, 21. We lost 2 basis points on the forward multiple. And that's because earnings have been rising quicker than the S&P 500. And that's what Ed Yardeni is calling out here. This year's so-called melt-up has been led by a melt-up in earnings rather than in valuation. And that's good news because an earnings-led bull market is much better than a price-to-earnings-led bull market. The former is less prone to sell-offs. Right? If you're led by earnings, you are less prone to sell-offs and corrections because it is supported by fundamentally strong earnings. And when I say your North Star is earnings, folks, the Fed this, supply lines that, shortage of chips, peak inflation, peak wages, poor jobs growth. Your North Star is earnings. As long as earnings are good, you buy the dip. All right, our target, Ed Yardeni of Yardeni Research, their price target for the S&P 500 by year end 2021, 2022, and 23 are 4,800 for 2021, 5,200 next year, 5,500 the year after. So we got another 4,800 here from Ed Yardeni. I think that makes 3 or 4 from the strategist community with 4,800 year-end price targets. I believe that includes Fundstrat, Tom Lee, as well as Chris Harvey from Wells Fargo. I'm sure there's one more that I'm forgetting. All right, we talked about seasonality at the top of our state of the market. Let's get right into it. November seasonality favors the bulls. Indeed, no matter what time frame you're looking at or presidential condition you're looking at, we generally have pretty strong results for the month of November. Fast forward. As I've said before, we're entering the best 6 months to own stocks, November through April. So consequentially, we're also in the best 3-month period to own stocks, right? The next 3 months tend to be the best 3 months within that 6-month time frame. As you can see, October, November, December. This is October through December. This is November through January. And this is December through February. So right here, where we are right now, going back to 1949 for the Dow, this time period has the best 3-month rolling average for Dow returns. We can look at the same thing for the S&P 500 rolling 3-month returns since 1949, and we are in that 3-month period. Naturally, in the NASDAQ tends to have the biggest gain at 6.3%. NASDAQ only goes back to 1971, folks. So 6.3%, 4.3% for the S&P, and 4.3% for the Dow. But we are smack dab right in that best 3-month return. Now, this is within the NASDAQ. This is just the NASDAQ 100. November, for the NASDAQ 100, the win percentage, going all the way back to 1989, is 70, we'll call it 72% win percentage. I mean, 72% of all years in the month of November, the NASDAQ 100 is higher. For December, 82%. 82% of years going back to 1989, the month of December, produces a positive return for the NASDAQ 100. Why? Like, why is this time frame so, heavily, loaded for the bulls? It has to do with, and we talked about this in our trading room during the course of the week, it has to do with fund managers, really. Fund managers are underweight equities. They're underweight risk assets for the majority of the year. It's part of their business model. Look, the less that they have at risk, the less they have of downside in the portfolio or in the fund. And it became this self-fulfilling prophecy back in the 80s, whereby fund managers would be underweight risk through the first 3 quarters of the year. Then in the 4th quarter, look, you've got to beat what somebody's getting in their savings account. You've got to be able to beat the 10-year yield. So you wait and you've reduced your time frame. So you do have limitations to the downside by reducing your time frame as well. Naturally, if something bad goes on in the 4th quarter, you also reduce your time frame for where you can make up for it. But since that time, what we've seen in the way of fund managers is that at the end of October, they leverage up. The average 2-week stock market exposure of bearish active managers, these are the most risk adverse, asset managers. But even they leverage up from October through the end of the year. October 2020 through the end of the year. October 2021, leveraging up their market exposure. Again, you have more inflows than you do outflows. All right, let's talk about some quantitative. I know we're up 22% in the S&P 500. It can't get any better than this. In fact, we've probably pulled forward, right? I think that's what most people think. You're up 22% this year. The S&P was up 18.5% last year. The year before that, the S&P 500 was up 31% on the total return basis. Like at some point, we're going to have another big correction, aren't we? We must have pulled forward a lot of gains into 2021 at the very least. It's not the way it works, folks. Again, the market's not on a schedule. There's no expiration date. It doesn't clock in and out. It's not due for anything. The whole notion of mean reversion in the market is a bit misguided. If we're going to mean revert, that means we're going to possibly drop 20%. Because that would be true mean reversion and below even the 200-day moving average. It's not what the market does. Objects in motion tend to stay in motion. Gains beget gains. New highs beget more new highs. We can validate every one of those statements with this year's performance, with last year's performance, with 2019's performance, with 1995 to 1999, double-digit gains every year, 5 consecutive years. Who's to say we won't have 4 consecutive years of double-digit gains come 2022? What this table here shows us is the 6-month returns for the S&P 500 over the last 50 years by different 6-month periods, January through June, February through July, November through April. That's where we are. That's the best 6 months to own stocks, as shown. The average return, 6.93% going back 50 years. The percent positivity rate is also the best. Yeah, it's tied for the best with February through July over that time frame. 76% of the time, the market is higher from November through April. It has the best returns during that time frame. So in speaking to, well, we must have pulled stuff forward. And I'm arguing that's just not supported by the data. Here's the November through April returns. Like we've taken it out from here, and now you just have it going back 50 years. So what if the S&P 500 has already been up a lot going into the best 6 months to own stocks? While the May through October period averages a gain of just 1.99%, right? Because the sell in May, right? May through October, sell in May, go away, come back in November. So the May through October period averages a gain of just, let's call it 2% over the last 50 years. The current period for May through October, we gained over 9%. Again, speaking to, it seems like we outperformed the usual. May through October, average 1.99%. We did over 9% in that time frame, just ended. So I thought this could be telling us, lower expectations over the subsequent 6-month period. That's not what the data tells us. Prior May through October, if you've gained 0 to 5%, the median, the average return going forward in the November to April timeframe is 4.25%. We did over 5%. The average return, if you do over 5% in the May through October period, is almost 11% gains. Momentum begets momentum. New highs beget more new highs. Indeed, the data does not support that we pulled anything forward. The data tells you to expect more gains. Look at the percent positivity rate. 88% when you've gained over 5% May through October, 88% of the next November through April timeframe, the market is up with an average gain over that time period of 10.77% for the next 6 months. Obviously, this is not 100%. So there is a 12% probability something could go wrong. I'd almost, I try to explore that. What could go wrong? Play devil's advocate. What could trip up this market over the next 6-month period? This is the VIX also, November. Not good for the VIX. We've talked about seasonality for the markets. This is seasonality for the VIX. And in November, the VIX is only a 25%. This goes back to 2001. So since 2001, the VIX has been higher by the end of November, only 25% of all years. That's it. And even though the average is actually a decline, we've declined on average in the month of November, 8%. Now, gets a little bit better in December. Why? Why does it get a little bit better in December? I think, again, it also has to do with fund flows. We'll get to fund flows in just a moment. All right, so with the strength of this bull market, this is Bank of America's sell signal. Right? This is their extreme bullishness, bearish for stocks. When the bullishness rises to an extreme level, this tends to be a contrarian signal for the market. This one just came out in October there, end of October, and you can see where we were just touching or just about to touch the red line, which is the contrarian signal or sell signal for equities. We've talked about this before, folks. Here in July, talked about it before also at the beginning of the year in February. Could the market have some kind of hiccup? Absolutely. It's had hiccups throughout the year. When you see the term sell signal, it really should trigger your buy the dip impulse. Don't be selling. Don't be a net seller. You always want to be a net buyer. It doesn't mean you can't sell stocks, lock in gains. But what you want to be doing with those gains, with that capital, is rotating it to something else. I don't think you want to lose exposure to this bull market. I've said that every single month this year. Every single month this year, the S&P 500 has made a new high. We've now made new highs going back to last year, 13 consecutive months. The only time that beat that was in 2014 with 15 consecutive months of record highs for the S&P 500. You don't want to lose market exposure. You should be a net buyer, not a net seller from some arbitrary signal, based on criterion from Bank of America. Market won't let me get in, right? And this market's just going up. Indeed, it is not. That is not the case. We've had 11 pullbacks since the great financial crisis, 11 pullbacks of 5% or greater. We've had 3 pullbacks that were 15% or greater, 2011, 2015, and 2018. Each of those years had more than a 15% correction in the S&P 500. The biggest one being in 2018 of 20%. The market's letting you in. You need a game plan. The people that constantly are saying this market is just going straight up and all they're looking at is the price of the S&P 500, they don't have a game plan more than likely of what to do when the market does give you a dip, 2%, 3%. 5%, 7%, 10%. You should have a game plan that outlines what you're buying in different tranches as the market retraces and validate that you should continue to buy should the market continue to draw down even lower. The game plan takes all the guessing game out of it. It gives you something reliable, tangible, something that you can reference instead of using CNBC or Bloomberg as your reference. What they'll do is make sure that your hands go right underneath your butt and you're just watching price. They'll do a good job of keeping you on the sidelines with fearful narratives. Your game plan shouldn't. You got to get into this habit of just, this is what my game plan says. I've got to execute it. If not, I'm just flailing about. I mean, really, like one of those inflatable tube guy things on the side of the road, just flailing about. You're looking for answers any which way you can find them. Have a game plan. And in the future, you'll be able to know what went right, what went wrong with your game plan. And you can course correct. But if you're constantly having to tune in to whatever the programming is on CNBC for answers, or folks that you follow on Twitter for answers, but you don't know what the next program is going to be. You don't know when that next tweet of reliability is going to be. Your game plan is solid. You determine it. You know the disciplines that you need to employ. It's just about executing the game plan. Most of investing, most of trading is about discipline. It's about maintaining an equilibrium with your emotions. IQ makes up a portion of a successful investing regimen, but your emotional stability is of the highest consequence. All right, market breadth. We came into this week, where we were actually seeing underneath the hood of the S&P 500, a lot of stocks were actually down, rising. We saw more stocks down 10%, 20% or greater on the rise. So more and more stocks were actually down double digits when we came into this week. It did get better though. This was a look at the S&P 500's advanced decline line at the beginning of the week and before, right? Because it almost made a new all-time high. Why is that relevant? Because of course, we're looking for validation in what the index is doing. When the S&P 500 makes a new all-time high, we want to see that a lot of stocks are advancing with the index. We don't want just a few names holding it up. Because if those few names turn over, and the rest of the market is already weak and hasn't been advancing with the index, we have a greater probability of more downside. So when we see the S&P 500 making a new all-time high, we want to see the advanced decline line making new all-time highs. And indeed, that is what happened on Tuesday. It's what happened yesterday on FOMC day as well. The S&P 500 advanced decline line making new highs. The NYSE advanced decline line also making new highs. This chart here from the sentiment trader, at the close of trading on Monday, a model identifying cyclical industry participation registered a new buy signal. For the first time since this time last year. History is repeating, folks. Perfect example. This is a cyclical industry model. Basically, most of the sector ETFs, if you will, are cyclical ETFs. We're talking about industrials, materials, consumer discretionary, financials, energy. These are your cyclical industries, and they've been in an uptrend. And so it fired this buy signal according to sentiment trader. Right here, you can see the big candlestick there. And let's see if we go back, June. Yep, here's November and December right in here. That was the one in November, and it continued in December. And so here we are in November of 2021, the same signal firing, which again just kind of confirms what we're seeing in the advanced decline line. A lot of the cyclical sectors are in an uptrend. They're advancing rather than declining. Here was another one we focused on so far as breadth confirmation of what the indexes are doing, hitting new all-time highs. We wanted to see an equal weighted version, of market, of the total market hit new all-time highs. And that's what you get from the value line geometric index. So we took this from last week's state of the market, and we could see Even though the S&P 500 hit new highs last week, even though the NASDAQ and the Dow hit new all-time highs last week, the value line geometric index was in an uptrend, but not quite hitting the highs that it set back in June. Fast forward to yesterday, and we have success. New all-time highs on the value line geometric index. If anybody says to you, well, this market is BS, it's just pumped up by the Fed and this, well, they're more than welcome to their opinion, but this is the reality. Most stocks are moving higher. This move from the September, well, it was actually in October, the first week of October bottom. This move since then has been very, very broad. We're hitting new all-time highs in the indexes, in the advanced decline lines, and in the value line geometric index. Broad participation validates what the indexes are doing. Yeah, the bears don't have to like it. Nobody's saying, well, please enjoy it, participate. Nobody's doing that. You don't like it, go ahead. We'll see you in 2022. All right. Now, as I said before, we had this 7-day rally there in October. And that 7-day rally in October coincided with the RSI, the 5-day RSI, elevating to almost 90. Nice 7-day rally. And a little bit interim dip there, but then we had a bigger dip right here. So we got overheated. Look, the RSI over 70 or above is what we technically identify as overheated and overextended move in a stock, in an ETF, or in the index itself. Well, guess what? 1, 2, 3, 4, 5 days up in a row as of yesterday. We're still up right now. And look at the RSI coming into the day, 89.78. This dip right here equated to an intraday dip of 20 points. By the closing, we were only down 5 points from the previous session's close, though. This was a nice 20-point dip that alleviated a lot of this overbought conditions. We rapidly picked up where we left off, and we've been up 5 days in a row since, reigniting these overbought, overextended conditions, overheated, I should say, overheated conditions. Here's where we are. This was as of 12:46 p.m. We do have the RSI, the 5-day RSI, almost 91. And it does at 3 o'clock power hour, we're still up 9 points. Now here's the thing. As I said, that dip, this was 20 points intraday. During the course of today's session, after we made all-time highs at 46.83, we dropped down 18 points to 43.65 before again rallying, and now we're chopping around. For an investor, for a trader, an active portfolio manager, you look at this and it's about expectations. You use this to recognize what might be lying ahead, which is a potential dip, or at the very least, sloppy price action. Tactically, what should you be doing? Well, again, an active portfolio manager, an investor, a day trader, there's different strokes for different folks. I'll give you from my perspective. I'm an active portfolio manager. I see the RSI getting this extended. Again, I see what just happened in the rearview mirror. I've seen it all year long. Here we are. Look at the RSI, 5-day RSI. This was back in July, getting up to 90 here, and we got a dip. Momentary, that resulted in new highs, but a dip nonetheless. Here we are back in April. RSI gets to 89.90. Look at this sloppy price action right here. You get these overextended conditions. If you have core holdings, maybe they've reached some of their price target objectives. You lock in some profits, rotate that capital to something else. This is the market. It's not each individual stock. It's not every sector. There's always going to be something else you can buy. You lock in profits here, and I'll rotate the capital into something. I'm buying something else that isn't overheated within the S&P 500, within this particular sector or that sector. There's always something you can do on an intraday basis. For the index itself, it wouldn't surprise me if in the very near term we got some sloppy price action. If we don't, good, fine, great. This was a moment in time, a blip on the radar. That's it, 5 points, 20 points intraday, which we rallied into the close. We bought back 15 points of the 20-point drop intraday, which tells you you want to own this market, folks. The dips are shallow. They're few and far in between based on this 3-day win streak, 3-day lose streak, 7-day win streak, 1 day down, 2 days, 1 day down, 5 days in a row now. We've got the seasonal tailwinds. We've got earnings revisions to the upside. We've got good news on vaccines. We do have easing of the port congestion. We do have some good news outside of the United States with international markets, and there, Vietnam taking down some of their restrictions. Their manufacturing sites for Nike are back up and running. So there's a lot of former headwinds that are now becoming or are solidified tailwinds at this time, which I think you could argue we're seeing in the economic data as well. We're seeing some re-acceleration in certain economic data points. The ISM services manufacturing data this week, we got up to 66 from 62. We jumped up to 66. The service industry is coming back. That in and of itself will also facilitate an improvement in the supply lines. We're spending more on services, less on goods. Give those goods manufacturers a bit of a break. All right, we always, again, a good portfolio manager, a good savvy investor focuses on disciplines. Discipline, discipline, discipline. Look at this upside down pyramid structure, which tells you where most of your emphasis should be. Patience, your emotions. Then risk management. The least of your concern is technical analysis. You control this. The rest, easier. They're just easier. You gotta control this aspect of your investing and trading disciplines. Something we talked about last week as well in the trading room. Unfortunately, or fortunately, depending on how you participate in the market, most investors, most traders, they'll be out of the market within the first 2 years. They'll be out of the market. You can click the link in the first 2 years. There was a study done by New York University. There was a study done by Congress back in 1999 during the dot-com boom and bust thereafter. But what they basically found is that only 7% of traders will remain after 5 years, and only 1% of all traders can profit net of fees. 80% will quit within the first 2 years. 40% trade only for 1 month. All traders start with the dream to get rich quick. Discipline doesn't work that way. It wouldn't be a discipline. It would be a contradiction to the term. Discipline, there's an underlying connotation to that word that suggests time, patience, an arduous journey, if you will, dedication. That's not how you should approach the market. You approach the market with a get-rich-quick scheme type of mentality. This is the category you'll likely fall under. Discipline, discipline, discipline. It's the only way it really works. Oh, and I know all the stories about the meme stocks and Wall Street bets and Reddit and this and that. I get it. We're in this regime where it seems like discipline doesn't matter. I'm sure that's what the folks in 1999 were saying, 1998, 1999. I'm sure that's what they were saying. Look, folks, the stock market's not a bubble. It's not. But there are still pockets of excess in every bull market. There are pockets of excess in this one. And the folks that are dabbling in those areas of the market have a higher probability of finding themselves in this category, this category, this category. Discipline. Something I tweeted out the other day, a QB who throws a pick six for you football fans, right? The QB drops back, throws a pass, gets intercepted. The other person's team, he runs the ball back all the way for a touchdown. That's called a pick six. QB who throws a pick six has to have a short memory or risk drowning in negative sentiment. Investors need to learn how to take losses well, move on to the next opportunity, and learn from the past. Think of the trading year like the gridiron. They call the football field the gridiron. Short, complete passes lead to touchdowns. That's it, Throw a lot of passes. Don't throw Hail Marys. It comes down to position size, right? That's what we're talking about here. The Hail Mary is that long pass. You're trying to get a touchdown at the very end of the game, usually, to either tie the game or, win. They have a very, very low probability of completion rate, the Hail Mary pass. But the short passes, 5, 10, 15, 20-yard passes, have a much higher success rate. A lot of completions. It's the same thing with investing. Keep your position sizes small. The bigger your position size, that Hail Mary position size, is going to get you in trouble. It's too much risk for a person's portfolio. When it doesn't work, now you got games going on in your head. Forget the football field. They're in your head. You're watching your portfolio, that big position, take it down. And it's going to do stuff up here. So just like throwing short passes, take small positions. Position size allows the average trader to demonstrate that a perfect entry matters far less than And it's supposed to say a good entry. It's only when a position size is too enthusiastic to be nice, right? It's only when a position size is too enthusiastic that entries demand greater precision. I don't need a perfect entry. And when you give yourself, leeway by way of having small position sizes, more often than not, the price entry doesn't even matter. Goes down a little bit, as long as you know the fundamentals, you can buy more. You're rewarded. You have the same fundamentals and you can get it at an even better price than where you started. I'll take that value all day long. I like giving myself a good margin of error when it comes to price entry. And really the only way you can do that is with your position sizing. That's a form of risk management. All right, let's move on to tapering. One of the things that we talked about earlier this year, because we started this year with when is the Fed going to taper? When is the Fed going to taper? When is the Fed going to taper? So we understood what happened in 2013, 2014. when the Fed first announced tapering was May 22nd, 2013. And the S&P 500 dropped about 6%. And it took a good month. We don't have that kind of liquidity in the market anymore, so things happen faster here since 2016, basically. But that's it. That was your taper tantrum, if you will. The market took off into and through the end of the year. Bond yields are in red. S&P 500 is in the green. Higher highs into the end of the year. That's your taper tantrum. That's what everybody was so worried about. Maybe that's what September was pricing in. You don't know. But going back to what I said earlier this year, let me get to the next chart of tapering. Oh, I don't have one. Our sample size that we were so concerned about all year long, these strategists and analysts and so on and so forth, they have a sample size of 1. That's it. There's no guarantee. We had a 50-50 shot. We were either going to replicate what happened in 2013 or we weren't. A sample size of 1. It was the same thing with the contested election fears back last year. Our sample size was basically 1 in the modern era, and that was the 2000 election. In the 2000 election that was contested, the market went down from November through the end of the year 7%. Again, sample size of 1 in the modern era and 7%. That's what everybody was freaking out about ahead of the election last year. When you put these things into perspective, you give them some additional context, you realize these folks do deserve an Emmy on CNBC and Bloomberg because they can get you worked up over what amounts to nothing. It's really nothing. Normal market operations. So yeah, maybe these folks deserve an Emmy. A lot of notes here, from tapering and what have you. Goldman Sachs, we are pulling forward our forecast for the Fed's first rate hike by 1 full year to July 2022, shortly after tapering is scheduled to conclude. We expect a second hike in November 2022 and 2 hikes per year after that. Now, is Goldman Sachs wrong for saying next year we're going to have 2 rate hikes? Right? Before, I would say up till September, people thought maybe 1 by the end of 2022, maybe 1. They're saying 2. And the first one could come as soon as July, the 7th month of the year. When you look at Fed Fund futures, they're actually in agreement right now. They are showing a probability of 2 rate hikes, but the first one in June, which is when tapering is, as of right now, just doing the math, is supposed to end. There's a lot of time between now and June or July. There's a lot of time. And between now and then, we just don't know. We just don't know. If the economy keeps humming like this, reaccelerates, if we see the unemployment rate get or identify maximum employment, which is one of the Fed's dual mandates, and we can't get the reflation to start a new disinflation period, then yeah, maybe we do get a first rate hike somewhere in the middle of the year. That's not the boat. That's not the way I'm leaning. I'm not leaning to that side of the boat. I think that as a committee, the Fed has learned this is just futile, doing this nonsense up and down with rates. There's no utility there. I think the Fed is going to continue examining how to implement yield curve caps as a greater tool than these up and down rate moves. Main point, there's a lot of time between now and then. All of this is speculation as to when the Fed is going to make their next move on rates. 3-day changes after previous FOMC meetings. The S&P prior day close, so the day before the FOMC meeting, closes 2 days later, so the 2 days after the FOMC meeting. Usually, the market is down. The point change, the average return is down. In fact, the only time, if we look at, this goes back to 2020, that's March 2020. These are the meeting dates, the FOMC meeting dates. Negative, negative 2 days later, negative 2 days later, negative 2 days later. Positive in July, negative, positive in November, positive there in September, before we started to roll over. November. But most of the time you can see 2 days later the market is red. So yeah, we had a really nice rally yesterday after the FOMC meeting. We carried it forward here into today's session. We're still up 11 points on the S&P 500. We'll see what happens. It was up last November. Maybe it'll be up this November, today and tomorrow, to end the week. And if we are, well, maybe we're talking about being up 7 days in a row again. You want to own this market, folks. Taxes, well, you know, with the Biden agenda, the White House administration's agenda to raise taxes, and there's a high probability that we're going to have a divided Congress once we get into 2022. Midterm elections, it's looking like the House might flip. So right now, based on the predictive market, 93% believe there will be no corporate tax rate hike. I've been of the opinion, I've been saying this basically all year, it's extremely difficult to raise taxes, whether they're income taxes, capital gains taxes, or corporate taxes. It's extremely difficult to get that passed in any year. But a midterm election year? Which senator, which congressman wants to run under a campaign where they're raising taxes? The income tax on the rich, what do you think senators make? They qualify. You think they're going to vote to raise their own taxes? There was never a really strong probability of raising taxes in 2021. And the way that things are shaping out in the political market, or the political landscape for next year, it looks like the House may get flipped. And we're once again in a divided government. Good luck raising taxes in that environment. But let's say we do. For everybody that fears rising taxes and looking for another excuse not to leverage up into this equity market, given that we have a good economy, given that we see jobless claims dropping 4 weeks in a row to their lowest levels of the post-pandemic period. We've got a non-farm payroll report out tomorrow. The ADP private sector payroll report came out better than expected. We've got service sector PMIs skyrocketing. You want to make taxes your impediment to leveraging up in that environment when earnings are rising? All right, well, let's look at the data. Going back to 1940, every time they've raised taxes, 3 months before taxes are raised, the market tends to be higher 87% of the time. After they raise taxes, the next 3 months, the market is up 87.5% of the time. The next 6 months after taxes are raised, the market is still up 75% of the time, and still the average gains are pretty darn consistent. 12 months later, the positive percentage drops a bit down to 62.5, but look at how high the average returns are. What the data tells you is that taxes don't determine the S&P 500's returns. Earnings do. Revenues do. Gross profit margins do. Focus on the economy. The taxes will take care of themselves. And by the way, this is all about the corporate tax rate, which none of these S&P 500 companies pay. They don't pay the actual tax rate. They pay the effective tax rate, which is lower than the actual tax rate. The current actual corporate tax rate is 21%. Most S&P 500 companies are only paying about 15 to 17%. Garbage. This should not be a reason to be fearful about the market going forward. All right, let's get into the quant data, folks. What happens after higher corporate taxes? Well, again, pretty much told you, next 3 months, next 6 months, next 12 months. This is not something to be feared. 6 quarters, the S&P 500 has been higher for 6 consecutive quarters. With these kind of win streaks, 1 quarter later, market is up 85% of the time. 2 quarters later, the market is up 100% of the time. Over the next 4 quarters, when you've had at least 6 quarters up in a row, as we were here, that was the one time it didn't. So we are looking for a positive 4th quarter. But 9, 9, 14, 11, obviously higher, higher, higher. The odds are the market is going to be higher 85% of the time. And look at the 4-quarter return average for the S&P 500, 15.5%. We're still talking about double-digit gain probabilities for all of next year. A good first 10 months for the S&P 500 index could mean more bullish action. When the S&P 500 is up greater than 20% year-to-date return at the end of October tends to see continued strength. We were up 21% at the end of October. November, when you're up greater than 20%, November is higher 100% of the time. The average return, 3.7%. This is just the average year, like any year. So this is better. The average return is better, and so is the percent positive better than any other year. Final 2 months of the year, which would take us through December, again, the market has never been down. The market has never been down. When we go into November with greater than 20% returns year to date, the market has never been down. The final 2 months of the year, November and December, the market is up 6.2% on average. Looking for the lowest return, 1.3%. That was 1975. Man, most years, there's a 13.6 there. That's way too far back in my opinion. But 5, 6, 6, 6. I mean, it sounds very probable. November through April seasonality scenario. Going back, this goes farther back, right? Earlier we talked about going back 50 years. This study for November through April seasonality goes all the way back to 1928. And it considers, let's see, is the strongest 6-month period of the year for the S&P 500, with the S&P up 71% of the time. That goes back to 1928, up 71% of the time. When May through October is above average, November through April follows suit and is up 76% of the time. The average return, 7.5%. Not much different than the Schaefer's analytics study that we looked at. So even though that only went back 50 years, so that's 1970, even if we went back to 1928, the data is very similar, which tells you, shorten your time frame, elongate your time frame. Human behavior doesn't change with this market. Momentum begets momentum. New highs beget more new highs. You need something consequential to disrupt human behavior. This was a study that we had looked at, I want to say, this was September 15th. This was the study from Krishivaka, and it basically outlined 541 calendar days from a ultimate low, which took us back to the lows of March 2020. And so all of these years from a low point, 541 calendar days later, had very similar upward sloping moving averages. This is us here in 2021. So if we look at all of these individual years, we can determine, what the 2021 path forward into the end of the year might look like. So we were 541 calendar days away from the low, with only at that time 107 calendar days left. As you can see, with only 107 calendar days left, if we took all of these years that are similar to 2021, the 107 calendar days later, the average gain was 6.2%. The next year, look at that, 15% average gain, which is almost the same as what we saw here in the quarterly win streaks. 2 years later, 3 years later, 4 years later, folks, that is a crap load of green on the screen. What about drawdowns, right? What about drawdowns? Because in September, we had a 5% drawdown. So we look at the 107 days remaining in the calendar year from September 15th, when that study was performed by Krishivaka, the average drawdown, the average max drawdown, I believe this should be, this is the maximum drawdown. So in each of these calendar years, the maximum 4.12% was the biggest. But if you take all these max drawdowns from each year, some of them didn't have one at all. You get 1.88%. But why I wanted to look at each individual year is to see how bad it could be. And it turns out we had the worst at 5.2% this year. We delivered the worst. That's okay. We knew the averages, and we knew that we could see a 4% one. We knew we could see a 4% one, but we knew we needed to buy that, because almost every single year we finished the final 107 calendar days of the year in the green, 87.5% of the time, with an average return of 6.2% over the next 107 calendar days. All right, November. I mentioned fund flows, I think 3 or 4 times throughout this State of the Market, and here's a good look at seasonality for fund flows. This is the different macro groups. You got equity fund flows, you got municipal bond fund flows, and they're all color-coded. Average S&P 500 monthly return is, your zigzagging lines here. What I wanted to hone in on was the equity funds, the equity fund flows. And as you can see, September, negative. Historically, this goes back to 2000. Historically, equity fund flows are negative in September. We knew that in September. There's that dynamic where kind of all the stars align, so to speak, including outflows, whereby you have a greater propensity for the month of September to deliver a negative return. But then the fund flows start coming back in October, and look at November. a lot of fund flows into equities going into the end of the year. Uh-oh, what happens in December? You have the largest outflows. Why? Raise your hand. No. Pension fund rebalancing. It's usually pension fund rebalancing at the end of the year. Doesn't mean the market's down. It just means that, you do have that market operation dynamic whereby you have less gains than you did in November. Because remember, atop this weekly state of the market, November is better than December, and you do have more volatility in December than you do in November. All comes together very nicely. All right. This study also here by Sentiment Trader, going back to 1953. If you own the S&P 500 on trading day number 208 through the end of the year, the S&P 500 delivered a positive return 80% of the time. That's last week. So if you own the S&P 500 as of last week, going all the way back to 1953, the market delivered a positive return more than 80% of the time. We talked about drawdowns just a minute ago. Let's do that again with this particular study. Only 41% of the time, going back to 1953, did you have a drawdown of greater than 1%. 85% of all years saw a drawdown of less than 5%. 95% of all years saw a drawdown of less than 10%. So what does this basically help us with? Determining how bad things could potentially get by the end of this year. It's very rare to get 10 and 5% drawdowns this time of year. Now, this is a really good study. This is one of my favorite quant analysts, Wayne Whaley. Wayne Whaley, he's like the grandfather of quantitative analysis. He also defined and founded the toy barometer. The toy barometer stands for turn of year. And the time period for the toy barometer is November 19th through January 19th. He looked at every year for the S&P 500. And he looked at all different time periods. And what he discovered was that November 19th through January 19th delivered the most reliable signal of forward 12-month returns for the S&P 500. In other words, if during that time frame, the turn of the year, if during that November 19th to January 19th time frame, the S&P 500 delivered a 3.5% or greater return, it fired bullishly, a bullish signal, and every time it has done so, it has delivered a double-digit return. The average return, I think, is 16%. It has a 96% success rate. It's happened 37 times, and one of those times was 2020. In 2020, from November 19th to January 19th of 2021, we gained more than 3.5%. How much are we up this year, folks? 22%. So if we do finish this year positive, we will once again satisfy the toy barometer. But this particular study looks at the sell in May equals S&P 500 return, May 5th through October 27th. The buy and fall equals S&P return from October 27th through May 5th. So he's looking at this time frame, October 27 to May 5th. All right. Wayne Whaley said this time frame is also pretty reliable when you look for forward returns for the S&P 500. When the S&P 500 gains 5% or more from May 5th through October 27th, the index has then never closed lower from the end of that time period through May 5th of the next year. Never. Here's all. It's not like it's a small sample size, folks. You've got 20 times this has happened. The average gain is 12.2%. This is why we study the data. It gives us the probabilities. There's no accidents in the market. The market is just human behavior, and human behavior is extremely repetitive. So again, from May 5th to October 27th, it's a perfect 20-0 with rather strong average and median returns. And we did gain more than 5% during that time frame. 2021, we gained 9.36%. Gains beget gains. And last but not least, COVID trends. So once we got the approval for, the vaccinations for kids 12 years and under, we saw a skyrocketing of daily vaccination rates. We went from averaging 813 a day, 813,000 a day. We doubled that to 1.6 million. This is not a political message, folks. I'm not telling you what to do. I'm not giving you my opinion on vaccinations. I'm just presenting the facts. From an investor standpoint, look, if we want the full extent of what this economy has to offer, I don't see the higher vaccination rate as being an impediment. If I'm going to say politically correct, right? I don't see that as being an impediment. There's really only benefits that come from that. And that's science speaking. That's science. New confirmed cases of COVID-19 in European Union, US, UK, Japan, and Vietnam have mostly all been coming down. US is 50% off of its Delta peak, if you will. Last look here. Got 15 minutes to go into the end of the session, folks. And thank you for joining me here live with our weekly State of the Market. I hope you've enjoyed. Again, won't be able to deliver our weekly research report this weekend, but we will be back on schedule come the following week, the following Sunday. Also, as I've been telling, and there'll be an email on this as well, I will be taking the month off in December. Typically, we only have one research report that we offer in December. It's our year-end weekly research report, but I'll be taking the month of December off. I haven't taken a month off since 2017. I really haven't taken any vacations of consequence. So I do want to put that out there, but there'll be more of that, more information to come on that as well. So with that, let's call it a wrap. Thank you for joining me here on our weekly State of the Market.